Good morning, Jags. This is Fahad. Today is Monday, August 17th. Let's get started. One stock on my watch list and it's worthy of an attention. JD.com, symbol JD. Now, quickly, for those who do not know, a lot of our JAG clients should be positioned into call options because on July 16th in webinar, we recommended owning these call options going into earnings. As you can see right here, we recommended buying the September 62.5 calls for $4.90. So it's been a month we have been holding into this position, and this is stock or these call options will finally get paid today. Earnings just came out not too long ago, about within the last half hour or so. And so I'm looking at this earnings press release, and this is pretty darn good. And the stock is moving higher. So it closed at 62.06 yesterday. And if you look at pre-market, it's pushing towards $65 per share. And if you look at the longer term scale, this is a much better picture because you can see that after almost a month and a half long of consolidation, this is starting to actually move out of this consolidation. What is likely going to be today is a power candle breakout from this wedge formation after quite some time. So watch JD.com. It's going to break out through 65 and likely makes a quick run towards $70 per share. Very, very nice technical setup, and we already own September 62.5 call options. So keep an eye on this one. Now, looking at this earnings report, I should mention that I've followed this company for a long time, for several years. Each time when the earnings report comes out, I look at the data, I look at comparisons on a sequential growth basis as well as year-over-year basis. There have been previously some sort, hesitations among investors about JD.com because it was not able to continue to improve its top line revenue growth in a way that investors had originally expected a couple of years ago, which turned off a lot of people. And as a result, analysts had taken down the estimates. There were disappointments, there were downgrades, a lot of things from the past. But this report that came out this morning is rather a very clean, very nice earnings report. Number one thing that stands out for me is net revenues for the second quarter were up 33.8% year over year. This is actually, in my view, I was trying to remember, but this is the highest growth rate I've ever seen from JD.com since it went public. Growth rate previously had settled all the way back to low teens growth. So now we are seeing 33.8% year-over-year growth rate. I think that's going to set a very positive tone. More importantly, the annual active customer accounts increased by 29.9, or basically 30% year over year, to 417 million active users. And so mobile active users are up 40% year over year. I mean, all around, whether you look at the margin expansion, you will see that's also pretty strong over here. There was a Hong Kong listing that completed on June 18, so similar to many of the Chinese tech companies, that has diversified their pool of the total access to the capital. So that's going to continue to be positive for the stock as well. Lots of positive, particularly related to the retail sector, which in this press release, and I'm sure they will talk about this in the earnings call as well, they talked about management continues to sign up these major partnerships from innovative luxury fashion designers and labeling companies. A lot of the new launches happened in their flagship stores in JD.com. A couple of those were Japanese cosmetic companies. There was a drugstore called Daikuku that was also part of this. Christopher Kane was a luxury fashion designer that was signed off also in the month of June, that helped the quarter. There's a British furniture design brand called Tom Dixon, which was also part of this growth strategy that also helped. Also in the month of April, company launched instant delivery services for mobile products. So this is similar to Walmart Plus in the US or Amazon Prime in the US. So that is also diversifying away and creating a much better, stickier user base for the company, particularly for its retail business. So the amount of merchandise continues to increase. The logistics operation continues to increase. Similarly, margins are expanding. The number of user accounts on the website are expanding, and the total revenue growth of 33% is the highest I've seen from the company. And so based on all of this, I expect this stock to break out through 65, and let's see if it can make a run all the way to $70 per share. So keep an eye on JD.com. Plenty of bullish positioning in this name. If you go to the September month, you'll see there's over 33,000 open interest in the September 60 call options. And then similarly, 26,000 open interest in September 65 call options. Look further and you'll see that the October 65 calls also have a large open interest. A lot of this is bullish positioning that's recorded in Jaguars scan as well. So that's one quick update. Really nice earnings and a nice technical setup for a breakout. So look for this to clear through $65 resistance today or soon. That's it from me. Jay?
Hey, morning, Fahad. So one stock on my list today is IDEXX Labs. Ticker is IDXX. Started to talk a little bit about it last week as the company held an analyst day. Now, Credit Suisse is out with a pretty extensive note this morning, a 21-page note highlighting a number of different things. But one item that kind of catches my attention is their discussion on blood work and hematology. They start by saying how blood work is only performed at only 17% of IDEXX domestic vet visits and only 6% of international visits. Now, this is a metric they see could reach 30% and 17% respectively longer term. Now, one of the things that they are doing or emphasizing in terms of growth prospects for hematology is a product called ProCyte One Hematology Analyzer. They launched it last week in conjunction with their analyst day. And essentially what this does, it is a simple and accurate way to get a trusted complete blood count in-house. So it's going to simplify and sort of expedite the entire process. Now the company plans to launch this product with a global rollout for the first quarter of 2021. Now the product also is available for pre-sale in North America, so you may see some sales come out in Q4. Now let me just quickly show you, post a screenshot. One of the things Credit Suisse points out is on top of its current hematology installed base, for IDEXX, there is an estimated 96,500 incremental hematology placement opportunities globally, including 75,000 competitive and greenfield placements. So ultimately, just this one product alone presents, ample opportunity for further expansion. And looking at the technicals, you have seen a slight pullback in shares, but honestly, the stock remains in a strong uptrend.
So 17% penetration today, and this major product launch sometime late 2020 or early 2020 is likely going to accelerate that adoption. How big is it as part of total revenues? Because this company, when it comes to pet products and everything and a bunch of other things, this is so well diversified product with so many different things they sell. I mean, the product portfolio, if you ever go to their website, if you look at it, if you go through the earnings call, they discuss so many different things at every earnings report. Do you know, is it big enough from the total revenue standpoint?
Well, I know, as I mentioned, the 17% right now, that's just for domestic. 6% was for international visits. And so both of those numbers could possibly jump to 30% and then 17% respectively.
Wow. Okay. So definitely a contributor, and we'll find out over time in terms of dollars how much it makes the impact for the total. Interesting update. Did not knew that. I know SediVue has been a very, very powerful product for these guys for a long time, and the chart looks fantastic. This is what we like to see. Naturally came out with a strong earnings report recently too, with a big gap higher on high volume, and has been under tight consolidation and partially filled the gap as well recently. The trend remains quite strong as well. one to watch. Thanks, Jay.
Mhm.
Avo.
Morning, everyone. On my list, on my watch list today, I'm looking at Advanced Auto Parts. They report tomorrow. AAP is the ticker. I haven't seen much in the way of activity lately. It doesn't typically see too much options movement anyway. There is some accumulation in August and September near the money and at the money calls. Was looking at a note from RBC Capital back on the 13th, so just late last week. They raised their estimates given the reasoning is that given the sales improvement it experienced early in the quarter and the acceleration experienced by competitors in June and July, and the analyst remains bullish on AAP due to the needs-based nature of the industry. So we've seen a lot more personal vehicle usage lately since people are avoiding public transport. And also there was less new car buying. I think it was possibly more a function of stores, not stores, but dealerships being closed for a while because it has picked up recently as well. Besides that, let's see what else the analyst notes here. The comps shifted from negative to positive, ended up roughly flat for the first 4 weeks of the second quarter. So this was after the first quarter report. Continued sales improvement, like I said, from Napa and O'Reilly, which are competitors. So that's why the analyst raised the 2Q comp forecast up to 5% from previously flat. Now, the only thing that might be iffy here is Advanced Auto Part also has some commercial mix to it, heavier commercial mix than the other ones. So that might be like the one negative in here. Otherwise, because people are doing more work at home, and I don't mean working from home, I mean working on their own cars. It could be just small things, spark plugs, whatnot. So the analyst believes that this could provide an additional lift to the stock itself.
Couple things. First of all, technically, this looks fantastic for a breakout. It has been consolidating and recently on high volume. On Friday, in fact, it started to push through the $155 per share through resistance. So it's starting to eat through a lot of this VOP congestion levels over here. So technically, this looks great. Another thing to mention is that you talked about comps, turning positive from negative to positive. The consensus is looking for a 2.6% same-store sales growth when it reports, which is today. When is it?
Tomorrow. I have it as tomorrow.
Yeah, so it's tomorrow before market open. So 2.6% comps, but then if you look further out to Q3. The comps estimates on the street, they actually come down back again to only 1.1% year-over-year growth. And then when you look at the full year comps, they're actually still negative at 1.6%. So what this tells me is that consensus may have adjusted the estimates for the second quarter based on channel checks higher, but they have not done so for the Q3 as much. In fact, they're looking for deceleration again in Q3, and then same thing with Q4, with full year comps still ending down minus 1.6%. Now, with that said, considering the trends that actually have been improving, there's incentive for the estimates to move higher on the street for the next quarter. So I think that while the earnings will matter, I think the guidance will matter the most. If the company comes out and talks about that they're seeing the same trend that they saw in Q2 and continuing into Q3, then I think forward estimates move higher, and this should propel the stock higher along with it. Lastly, while you were talking, I saw that just quickly scanned through the activity, this 2,300 open interest in the September 150 call options, 1,750 of that was bought to open on July 30th, so not too long ago. And they paid about $11.20 for that. They remain in the open interest. So on a percentage basis, that's about $2 million in bullish bet in the September 150 calls that remains in OI. And so as a result, there's definitely bullish positioning going into this earnings report as well. So good stuff. I'll continue to look for any other further color before the earnings comes out, but the chart looks great. Option activity hot, and naturally, business conditions have continued to improve, and I'll see what else is out there that we can bring up to our clients' attention. Chronicle.
Morning. Couple minor things. First off, some commentary on DraftKings, symbol DKNG. So the stock sold off on Friday, not because of earnings, but more because of tax concerns. Basically, there was this internal memo from the IRS suggesting that fantasy sports companies ought to be paying Uncle Sam a cut of their entry fees. And the way the math works out, for up to 2% tax on handle on illegal wagers and 25 basis points for legal wagers, plus occupational tax increases to $500 per person accepting wagers, as well as retroactive payments, which is what the memo was suggesting. That can all equate to roughly a 20% tax on revenue if we include retroactive. So that's where the immediate concerns are coming from. But that said, the general takeaways are that this is unlikely to happen, at least not without a lot of legal conflicts. So Morgan Stanley was out with some commentary, and their analyst is saying we shouldn't be overly concerned because, first of all, this is just a memo, and DraftKings can challenge the potential ruling based on the definition of game of skill versus game of luck. But in case the rule does take effect, Morgan Stanley is estimating that daily fantasy sports are about a quarter of DraftKings revenue in 2020, but that exposure is projected to be less than 10% by 2025. So in the long run, it's not a major concern anyway. And also, roughly half of the states that DraftKings operates in have legalized daily fantasy sports already. And because of this, the analyst has worked out that it implies only a $20 to $30 million headwind in the worst case scenario, if we're not counting the hypothetical one-time retroactive payment. So in short, the long-term concerns here for DraftKings are overblown. And the second thing, just a quick update, is that Huya and Douyu announced this morning, almost at the same time, that they both formed special committees to consider Tencent's merger proposal. So keep a close watch on this. I think the sooner they get this done, the better.
Yeah, on the DraftKings, I saw the negative price reaction after earnings comes out, and I looked at the earnings report because I discussed this in Telegram. I gave a quick preview before earnings came out, and then I discussed it afterwards as well. Like, this is not driven by earnings at all. I mean, earnings were absolutely fabulous. I understand there were some concerns that the G&A expenses skyrocketed sharply, and so the profitability was much worse than what I thought for DraftKings in the earnings report. But that's to be expected, because when each time when you're going to continue to launch into a new state as they legalize, and you need to set up the technologies. You need to set up, form partnerships with local tribal casino operators, and all of that required works. And so as a result, I thought that the quarter, particularly top line revenue growth, was really, really strong. And I think market was just simply not paying attention to it at that point. Good point about the tax. These kind of things are transitory in nature, and they come and they make a lot of noise for a day or 2 or 3 days, and then people realize, why would this prevent me from continuing to like the stock? Why would this prevent me from continuing to own and have a stake in this company? And that's how it usually works. These things don't break the barriers. They don't break the backbone of the fundamental long-term bull case, but rather just create a lot of noise in the short term, and then money pours right back in. So I expect no difference this time in DraftKings as well as GAN Limited as well. Both of them. GAN had a much, much better technical performance, big spike. We own this stock right now, and this thing is going to perform very nicely. Very nice breakout on high volume from the base as well. And by the way, guys, while I was away last week, very big win for a lot of our clients. I just want to finish this off by discussing GRWG. What an impressive breakout in Grow Generation, GRWG. Massive breakout. This thing was up in a single day by like 45%, and then it continued to power higher once again with double-digit gains on Friday and closing at 1324. And I'm now looking at pre-market. It's going to open at 1420, so it's guided higher by another 7 to 8% in pre-market as well. It's going to open above $14 per share. So, and what a fantastic earnings growth with the Jay covered this, tweeted this out on Friday as well. Very impressive. Under the radar name, For those who were able to capitalize on this, we did discover this in webinar on July 16 as well, right over here. And we talked about this. We said this is the first time we're covering this. We really like the story. So for those who capitalized on this, monster winner last week and still continuing to power higher. All right, folks, that's it from us. Thank you very much for joining. Glad to be back on my desk, and we'll see you in the chat room shortly.